Hello and welcome, everybody. Welcome to a meeting of Manager Minds. This is our second installment, powered by Alexforbes, and my name is Msizi Msomi. And with me today, I'm joined by a very special guest in this Women's Month. We'll be looking at, how she constructs portfolios, how she thinks. Today, I'm joined by Delphine Govender. CIO and co-founder of Perpetua Investment Managers, and today she'll be unpacking some of her strategies, how she constructs portfolios, some of her thinking, and what drives her as an investment professional. And obviously, with Forbes being one of the largest multi-managers in South Africa with over 600 billion worth of assets under management. We lean on these best of blends in terms of finding the best asset managers out there to construct these portfolios. Whether you're an advisor or just someone seeking investment insights, you're definitely in the right place today with us. Welcome, Delphine.
Thanks, Msizi. It's great to be here.
Thank you for joining us today. And just to kick off, just tell us a bit about yourself. But before we do that, I just want to ask you something in terms of investments. There's this theory of buy a share, hold a share, sell a share, buy and hold, sell strategies.
Right.
So let's put it in a more, I'd say, fun context. If you were to hold something, buy something, and sell something, that would be, active management, coffee, or TikTok finance. What would it be?
That's a good one. Active management, I would say definitely a buy, of course, as an active manager. I actually always contrast active management a little bit as an analogy of versus passive, almost in a food context. I'm a foodie. And I almost think of active management as, made from scratch, a la carte item on a menu, which is fresh ingredients and made to taste and use skill, whereas passive is more like an all-you-can-eat buffet. So cost-effective, hits the spot, but you get everything: the good, the bad, and the overcooked. They both serve a purpose. So definitely buying the a la carte menu, so buying active. Coffee, oh gosh, coffee is a hold permanently. I think for anyone in this industry, so it's a hold no matter what. TikTok finance is going to be my sell. No disrespect to the current generation who live by it, but finance is much more than, I think, 60 seconds and a ring light. So that's why it's my sell.
Okay, awesome. Thanks for that. And you've been in the industry for many years. You've seen a lot of crashes, heights in the market. But what was that one thing that you'd say drove you into investments? Because I think you started off at Deloitte.
That's right.
Yeah. And what got you into that investment arena where you then took on this role of CIO, co-founder?
Yeah, that's a great question, Mzizi, and I think it's a intriguing question for almost any investor in terms of where did it first start? Where was that seed planted? Interestingly, for me, it actually started with my parents, not for the obvious reasons. I got no share portfolio. There was no share trading in my house. My parents were actually both lecturers, academics. My dad was in science and chemistry, and my mom in English and education. And I think that's a very interesting starting point because I always knew from a very young age somewhere I sat in the intersection between those two disciplines, being arts and science. And in fact, I actually believe that's where investing sits. I knew nothing about the endeavor and the profession of investing, but I did know I wanted to work in the field of finance. And that's when I picked, you mentioned Deloitte's, deciding to become a CA because I thought it would be a good broad space or almost springboard to go into anything business related. Deloitte is actually where the actual silver bullet was hit. In my first year of articles, just 21, I got a great opportunity to do an exchange program with Investec in South Africa and Merrill Lynch, who were not in the country back then. It says 95. And I went to spend 7 weeks at Merrill Lynch's offices in New York, at the World Financial Center, just off Wall Street. And in that 6-week period, the seed was completely planted for me about the world of investing and the stock market. And I came back I was in Durban at the time. I came back home. I did my research and I realized for me that the investment industry was mainly in Cape Town. So I promptly contacted the Deloitte's office in Cape Town and said, can I transfer my articles? I want to be in Cape Town. convinced my parents as their younger daughter that I was moving to Cape Town to get into investing. And sort of the rest is history. I was fortunate. I managed to get a transfer to Deloitte in Cape Town. Was actually, again, very fortunately allocated only to asset management audits. There was this little company called Coronation Asset Management that I audited. Old Mutual, Capital Alliance was an asset manager back in the day, Norwich Investments. And the Friday that I finished my articles, on the Monday, I started the following Monday as an analyst at Old Mutual Asset Managers. And that was in March of 1998, and have remained in the industry ever since, working my way up through the ranks.
Okay. No, awesome. And I mean, obviously, the way in which you construct portfolios, you have a philosophy.
Mm-hmm.
Maybe just talk us through this investment philosophy for someone new to investments.
Yeah, I mean, I think that's such a fundamental question. Ultimately, if I was talking to my, 12-year-old son or his buddies or my 81-year-old mother, and I was explaining, you're trusting me with 100 Rand or $100, what's the thinking behind how I would put that to work? Okay. And for me, actually, I would say how I would explain it to them, or how I do explain it to them, is that it's rooted in basically three things. Firstly, I think long term when I invest money. So that's a belief system. I think about the fundamentals. I look at actually what is it that I'm actually buying. And then thirdly, I focus on the underlying value of what it is that I'm investing in. And so to do that, you really have to have a call on the fundamentals. Okay. And the contrast with that would be, so it's not just simply, I would explain to my son or my mother, it's not just simply about betting on where share price is going to go. It's actually a much deeper, view, as almost as though we're becoming co-owners in a little part of this business. And so we're really tied to trying to work out the long-term fortunes of this business, all the risks and the challenges. And to do that, we've got to, it's some art and it's some science, so we've got to crunch some numbers about the future to really work out what we're willing to pay today. And is the market seeing a similar story? And if it's not, that's the opportunity. And so really those are kind of the cornerstones of my investment philosophy, which is really investing as though I would want to own this potential part of this business for a very long time. Mindful that in the actual profession of investing, we do circulate out of them because they're better opportunities at points in time. There's often a saying, would you buy something if you knew the stock market was closed for 10 years, and would you hold it? And so that's almost the kind of thinking, as opposed to saying, my son said, Mom, I want to buy something next year, some new trainer or something. Can I invest for 12 months? And I would say, well, that's about placing a bet. And that's not my philosophy.
Okay. I mean, obviously, the philosophy kind of informs, the whole process and how you manage money. I guess, obviously, you've been in the industry for a long time. And you've seen a lot of managers, asset managers come and go. And what would you say gives you or your firm, Perpetua, that investment edge? Is it more of process, people, or is it something else completely?
Yeah. To be honest, it's such an interesting, I think every single investment firm, every single investor grapples with this point. Because we would love to say it's a single element. It's almost, as they say, as elusive as alpha itself can be, unexplained and elusive. But the point about it is that we've got lots of ingredients, and ultimately I'd say the edge or your essence is your recipe. Some elements of the recipe are pretty unoriginal. They almost repeats of what other people do, which is quite common in our industry, and it's not to be kind of scoffed at. And some elements are quite unique, but the uniqueness and the edge is in how you blend it together. And so at Perpetua, I'd say, I just mentioned our philosophy. That's an element. It's not necessarily unique to us, but I'd say the way we stick to it could potentially be unique. The time horizons that we're willing to look through are potentially unique to us compared to perhaps what the market does. And the fact that we're less moved by what happens in the short term and much more by long-term changes. But I think critically then it's your people. And people is not just, a set of people or a set of jockeys at a particular time. It's almost like, what are those characteristics that individuals need to show about, deeply curious, insight-driven, values-aligned. Ultimately, this is an endeavor of stewardship. You're being trusted with other people's money. So it's not just meant to be an intellectual endeavor. It's meant to be something much more deeper that you take on board. And then critically, this process, all of this, we're speaking quite almost generally and a little bit philosophically. But every single day, we open our computers, we look at our phones, we look at our portfolios, and there has to be a system that is going to outlive me, that's going to outlive any of the team at Perpetua, that has got two things. It has a discipline, but at the same time, it's very alert to the fact that no process actually arrives fully formed. So continuously open to tweaks and changes that take the kind of information and data points we get every single day from the market, work out which ones are valid, which ones are not, perhaps they're just noise, and then take that information and get better and better every single day. And then lastly, I'd say in the investing endeavor, perhaps one of the things that is a critical part of this like special recipe is your attitude towards risk. How you view risk, what risk means to you, and then how you account both in the assessment but in the ongoing management of it. Because every single day we put a portfolio together on any given day, and every single day new information hits this portfolio that we have no control over. And you've got to work out, does this show up a vulnerability? Is it a threat or is it not? And so it's this combination of that is the secret sauce of a firm, but being able to, in the kind of intellectual honesty of your team, sit with each of these elements, unpack them, stick to them, and then also grow from them.
I guess also it speaks to that adaptability, when new information comes in, and how you then, align yourselves or position yourselves better to navigate any market
Absolutely.
environment. And I guess one then begs the question to say, how do you then build a portfolio? How do you then get to the nuts and bolts of it? Just maybe if you had a braai over a weekend and someone asked you, Delphine, probably you wouldn't be at a braai because you're quite a foodie.
They are foodie braais. They're called gourmet braais.
So at a gourmet braai, how would you then describe how you build a portfolio to someone that you're with?
Yeah. So the first thing I'd say about the job of investing, it's almost as though it never sleeps. So at every single point in time, we're sort of always gathering information. It's almost it's just part of one of your occupational hazards. And why but it's also a critical part of the endeavor. So the first thing is, where does the idea arrive? What is the reason that any idea is surfaced? And there could be multiple reasons. There could be something that is because of something you're literally reading, understanding, a new change that comes up, something that is physically launched in the market that you say that's new. It could be a dislocation. COVID happens, the world gets shut down, stock markets collapse, 30% over a short period of time, and everybody says, is that a permanent change? Is it a temporary change? So external events, which create an environment that say something looks interesting, something could look interesting. So the first thing is that combination of what surfaces the initial idea. From that point, then you go a bit deeper. So the example would be, once you first surface an idea, so say, retailers or banks in South Africa fell, tremendously in the first couple of weeks after COVID. Now, should a couple of weeks of not trading change the permanent long-term value of a business? Probably not. But why did share prices react as though they did? So the next thing to do is, well, not all businesses are the same. Which businesses might be more affected by not trading for a couple of weeks or a couple of months or shutting down? And so then we go into deeper research. So it starts from idea generation to then slight deeper research, rigorous research, going into the businesses, working out, can they withstand being closed for several weeks or months? Do they have the balance sheet? Do they have the finances? Will customers will they be more resilient in a downturn? How do they fare in their sector, in their industry? Are they a winner? Are they a loser? Do they have what it takes? And then that process can be typically individually done, but then we come together as individuals in a team with varying interests, varying competencies, varying understandings, and we debate some of these views. And the outcome of that debate is that there's no kind of single answer, but there's almost the weight of the room will start to say, we think this is, and obviously it results in evaluation. We think that this is ultimately an investment that is worth taking. And at that point, it would be approved for purchase. So that's almost the approval stage for buying and investing. And then the last critical stage, which is position sizing. So then actually an individual taking the discretionary decision to invest in that specific company into a portfolio. And then the aligned questions are, how much do I buy? At what price do I buy? And how do I then potentially buy more of it, increase what's my target weighting? So these are all the steps, and that's called portfolio construction. And say portfolio construction is both an art and a science. So there's definitely a science around how you would cap positions based on the risk, around expectations. What happens if stores are shut for 6 months and not 3 months? How could that business withstand it? What other businesses are affected by COVID in that example? You wouldn't want to have your entire portfolio affected by a single common factor. That would not be diversification enough. And then ultimately how you would choose to purchase on what day, at what price, is it a sufficient discount? And then that ongoing risk management around that position. Were the facts that you had when you made the approval decision, are they then the facts or the views that come to pass as time passes? And so there's this continuous feedback loop. Sometimes that's slow, depending on data points. Sometimes that's quick, if some event occurs. That gives you more information around how you continuously circulate this decision. But those are the critical steps in our process.
I like how you mentioned, risk is always something that you are constantly looking at.
Yes.
And obviously, it then goes on to my next question of, having conviction in a particular counter, in a particular view, and still being diversified. So how do you, because obviously they say diversification is a free lunch, so
Yes.
how do you then balance or marry the two between having conviction and also being having a lot of diversification in that portfolio? Yeah.
It's the ultimate trade-off, because it's the common saying, don't put all your eggs in one basket. But ultimately as well, if you over diversify, then you actually almost completely dilute your potential for excess return away. And so the question then becomes is what gives you the confidence to take a higher level of concentration? And typically it's around a clarity of view, a clarity of understanding, a narrower range of outcomes. So when there's very wide range of outcomes for a specific company, a specific sector, you might want more of them because small changes could change value a lot. But ultimately, I think of it as a portfolio manager almost in the notion of effective bets. So how do I build a portfolio of effective bets? Meaning, when I have a higher level of confidence and a higher level of certainty about a narrower range of potential outcomes, I'm able to take a bigger effective bet. When I'm concerned that many of the stocks in my portfolio are perhaps correlated to a very common factor, I might then want to diversify those, even if I have individual confidence in specific companies. So that is also a critical balancing act, and it's ongoing. But I would say it's that notion of not just lots of tiny positions which ultimately will not move the needle, because you then diversify even return away, but then also not hitching your wagon entirely to a single correlated outcome. That would not be prudent.
Yeah. And I mean, also in terms of how you position a portfolio, it also speaks to some of the themes that you're seeing out there in the market, and maybe just outline some themes that you're currently, grappling with, seeing in the markets or the bigger macro lens.
I mean, that's such an interesting. I think every single investor right now, globally and locally, is grappling with a lot of common big themes. I'd say the one that keeps coming back, and potentially it's because we've gone through this fascinating decade or 20 years, of very low interest rates. And what is happening right now, and it's been happening for the last couple of years of the recent past, is we're almost getting a repricing of the cost of capital. And in this process, we're starting to see what the returns and the premiums that historically investors in the last decade, because we tend to be very influenced by the recent past, and we almost assume as though this time it's different and everything that has happened in the last 10 years will now be the next 10 years. But actually we're starting to really absorb one of the biggest themes is what is the higher rate of required return I should be expecting from equities for when the cost of capital increases. So around the world, interest rates have been rising. Around the world, we have a higher expectation of stickier inflation. And I think this is starting to mean that the underlying most important input, which is that that hurdle rate of required return that I need to beat, is now a higher one, which starts to cascade a whole lot of trickle-down decisions around well, how do I then even value what used to be a, perhaps a more stable company, which gave me dividends, that is to a more riskier company. My risk appetite or the risk premium that I demand is actually repricing. But there's a lot of uncertainty around what that repricing needs to look like. So it's a big theme for investors around the world, and one I think you're going to start to see more and more of, which is why we have so much volatility at this point.
And I mean, when you speak of volatility, we saw first quarter of 2025. We saw themes like DeepSeek, coming out of China there, and it speaks to that broader AI theme. What are your views on AI? Friend or foe? Are you incorporating it in your process, or just maybe unpack that a little bit? Because it's a big theme. I mean, you've got AI on your phone, your car, your house, and even in the investment industry. So how are you?
Yeah. To be honest, I think AI is more of a theme. I think it's a structural change for not just for how we work, I think potentially for humanity going forward, at the risk of sounding overly dramatic. But my view here is actually pretty simple, because I actually hope that we are less denialistic about what AI means. And so my kind of approach is humans with AI are going to be better than humans without AI. So my view is, let's embrace it. Now, the reality is that the better outcomes are actually going to be this. We're currently living through almost the AI hype, the build out boom. So there's a hype in the stocks, there's a hype on the people that are producing the stuff that goes into building out, huge warehouses, data warehouses, etc. Everything that goes into the memory and the churning of the AI engines themselves. The second order effects are the ones that I think are much more interesting to me, whether as an investor, whether as somebody that's a permanent student of life. And that is what it's going to mean, which is both interesting and scary, I'd say. And that's perhaps why we have so much denial around those impacts. Interesting because it's actually creating a whole new kind of realm of what we can do and the efficiency and the productivity of how we can process information. And interestingly, investing is an information game. We start typically with the data, and then it goes to information, then it goes to knowledge, and then it goes to insight and judgment. And for many years, we would just all kind of equalize around information. I think what AI does, just to bring it closer to home, is it takes us straight, the word intelligence is there, it takes us straight to knowledge. So now the edge becomes the insight we bring. The 25 years of pattern recognition. How do we interrogate the tool to ask those questions? So, for those that would prefer that we could walk back AI, I'd say it's not going to happen. What does concern me is that I am confused in the world around the sort of guardrails that are in place for what could be the negative consequences, because I'm obviously speaking about some of the positive outcomes. But I do think it actually is also going to be the ultimate democratizer. I think often as a slightly smaller firm, having worked in big firms, we're often said, well, how does a small team cover, lots of shares, or how do you, and actually the question now, if we're all equalized at the knowledge point, you don't need large scores of many teams. You actually just need the right tools and people that ask the right questions.
That is true. I 100% agree with you on that one. And obviously, AI gives us some sort of, as you mentioned, it takes us straight to the knowledge base. And in terms of some of those indicators, besides AI aside, regionally, we're seeing a lot of headlines from the US, conflict areas as well. EMs, certain areas of pockets of excellence coming out of there. Are there any regions you are currently avoiding or leaning towards from what you're looking at from a macro thematic perspective?
Yeah. I think the way we look at it is we look to see kind of where is there the most attention going, and where are there most likely to be dislocations or mispricings because of lack of attention. And so for the last decade or two, and it really peaked probably at the end of last year in January this year, was almost all the attention was going to the US. Everything was centering around the US. And really to the detriment of the rest of the world.
Yeah.
Whether it was Europe, whether it was emerging markets, whether it was Japan, etc. And that seemed extreme. So for me, that seemed extreme that we had 70% of the world index even exposed to this single market for good reason, don't get me wrong, but the dislocation between the interest there and the lack of interest and the underinvestment. And so for me, what is more interesting is everything that is not US. Not because we're excluding the US. I think there's definitely pockets, and that's why it's always hard, to speak in sound bites and in general terms. But I'm very intrigued about some of the real structural changes, for example, that are going on in Japan. A country that for 30 years has had no inflation, suddenly starting to see that for 30 years, almost all the financials were produced in Japanese, and now 90% of them are produced in English because they're really looking to open up. So that's intriguing to me. Equally, we tend to conflate poor economies and poor outcomes for stock markets. Again, not true, because actually Europe has a poor and confusing economy, but actually there's real pockets of interesting, industries. And then emerging markets, I think, are fascinating. We tend to forget about, if there's a trade that we need to really pivot to, it's kind of the global south. And emerging markets have young consumers, low per capita consumption, high propensity to be the future consumers, great demographics. It's just that it's a much longer term duration bet, and it's harder to see. And most investors want to have the certainty of the next 12 months earnings, which is what they feel they get from investing in the US. But investing is really about doing both. So I'm really curious about the trends in the rest of the world ex-US.
Yeah, no, I mean, it's really quite an interesting time that we find ourselves in, especially in the industry. And, I've got some rapid fire questions.
Okay.
For you. Rapid fire questions
Right.
for you. I'm going to give you 5 questions. First thing that comes to mind.
Sure.
And so in the morning when you wake up, what's your go-to market indicator?
Oh, funny enough, to be honest, the Rand. But more recently, I've been looking at the yield curve a lot, and that's obviously just the change in interest rates, from short-term to long-term for government bonds. Something that I didn't before but I think we're dealing in such busy, volatile times. I'm curious always, not just about the change in expectations, but actually how expectations are shifting from one thing to another thing and the pace that they're doing. So I think that tends to give me that quickly.
Bull or bear market? Where do you find the most learning?
Oh, bear. Adversity, trouble is opportunity. I think also because bear is that ultimate leveler and that ultimate kind of gravity towards what can be true. Bull is about, optimism, sentiment. It's quite hard to actually separate, the truth from euphoria.
Yeah. Okay. That's quite interesting. And then in a bear market, obviously when markets are going down, so when you're experiencing massive drawdowns, how do you differentiate between having patience in the drawdown or something that requires action for this drawdown?
Yeah, I mean that is the tough one.
Yeah.
For me, it's, if I could distill it in rapid fire, I would say, if the facts change, act. If it's noise, sit it out.
Okay.
And so that's and then that is actually part of the secret, to try and distill between the two.
Okay. And obviously in investments and finance, a lot of myths that go around. What is the biggest myth in finance that drives you absolutely crazy?
Oh, 2. One is that value investing is risky. It's the biggest myth. For some reason, I think people feel that buying an undervalued asset can be a risky endeavor. It's not, because we do the work. And the second one, which appears to be how people make decisions, is that the second myth, which is always at every disclaimer, is that past performance is not a guarantee of future performance. But yet everyone acts as though past performance is a guarantee of future performance. So I'd say those are the 2.
Okay. Okay. And then for the final question, if you weren't doing what you're doing now, what would you be doing?
Oh, I guess it goes back to one of your first questions, which is, how did I get to investing in the first place? And it's about what makes me tick. So that intersection between art and science. So an endeavor, I think once you've worked for 30 plus years, the ideas you might have had that would have been your alternative jobs keep changing. I'm very curious about solving some of the mysteries of life and having interesting conversations. So maybe I'll be a podcast.
There's a future there.
Yeah.
There's a future there. And just to, obviously now we're Women's Month, and I mean you're also a pioneer in that area as well, where you give the girl child a reason to keep at it, to keep going. What would be the advice or takeaway to a younger Delphine coming into the industry? I mean, what nuggets would you give them, so that just to, as a motivator in their starting off their career?
Sure. I mean, for young women specifically, because I also have advice for younger people in general about knowing yourself and working out why you want to enter any field. I think we often see the lights and the camera and we think that's for us, or the title or the potential job, and we think, oh, that's where, or remuneration, that's where I should go.
Yeah.
But actually know yourself and really be comfortable in sitting in the kind of the boringness of the work we do. But for the young women, I would say, the history has made it seem as though this is not an industry where you belong, but you absolutely belong in this industry. I think so many of the qualities that make for good investors, such as curiosity, insight, having conviction, having empathy, these are not gendered qualities. They are like cultivated qualities and characteristics. And so this is why I believe actually an individual who really focuses on not just what is gender specific, but actually is cultivated and skilled. And I'd say for women specifically, because of the way we tend to be raised, this industry is about kind of curiosity, competence, and confidence. And then with that comes, clarity and conviction. But one word I didn't use is perfection. So I would ask the young women to leave perfection back in, matric maths, and not bring it into the world of work. Really focus much more on confidence than perfection.
Okay. I mean, quite interesting insights there, Delphine. We really appreciate your time. It's been an absolute pleasure having you today. And there you go, folks. Delphine Govender, CIO and founder of Perpetua Investment Managers. And whether you are building portfolios or advising clients, just need you to know that Alexforbes is the place you need to be. We're not just a trusted name. We've been in the game for over 30 years, providing and building solutions for clients, investment solutions for clients. Whether you're building portfolios or advising clients, you're in the right place. Thank you all for watching, and catch us at our next installment, where we'll be bringing you another guest to give us insights into how they see the world from investment lens, personally and professionally. Thank you so much for watching the show.